Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity.
Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the first time, a huge welcome to the community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited for this episode. We have got a CEO and an expert investor in the room with us. He has made investing more accessible for people like us. So a big thank you to him. But he's here in the hot seat. We've got a bunch of questions from his customer base and the Equity Mates community, and we're going to put them to him. So John Winters, CEO and co-founder of Superhero, I hope you're ready.
Thanks for having me. Thanks for having me back. This is the second time I've been here. About 3.5 years ago was the last time. So
yeah, we did the basics on brokers, I think. At the time, you guys had just launched around then. Yeah. I think you've been on a couple of times, more than once.
What a roller coaster since then.
It has been.
Global pandemic in the mix as well.
Some great investing opportunities. Zip, Drone Shield we were talking about earlier. It's been good.
Yeah, it's been
But
been
we were talking about, when you guys launched, it was $5 and that was the lowest brokerage at the time. How are they doing this? Now it's $2. Like, investing's becoming cheaper and it's good.
And, it's been a race to the bottom. We saw that in the US when Robinhood came out with zero brokerage. And when we launched at $5, we're Australia's cheapest online broker. And everyone was asking us, how do you do it for $5? Like, the cheapest guys are like 10 and the banks are all 20. And I think the banks are still around that, depending on the value you trade. But look, I think that price move has been an interesting one as we've seen more competition come in, and you really see, like, you're buying the same stocks, right? So it doesn't really sort of matter where you're buying it. It's like, what price are you paying? And the US really sort of unlocked that zero brokerage, which we saw come to Australia, and it's kind of going at the same time. There's different cost drivers here. But it's exciting. It's exciting being back in the hot seat at $2, leading the way there.
Yeah. So, John, we've gone to our community. You've also gone to the Superhero community to compile some questions. We're going to cover investing trends. We're going to cover your journey in Superhero and also just entrepreneurship more generally, and close out with superannuation and then what's the long-term play for Superhero.
Yep.
So let's start with investing trends and insights. We want to understand what Aussie investors are buying. So tell us, what are the most popular ETFs that you're seeing at the moment?
Yeah, ETFs have been, it's a wild success globally, but in Australia as well. And there's been a lot of talk about this sort of rush of millennial investors coming into the market, Gen Zs coming into the market and not knowing what to invest in. They actually do know what to invest in. They're all going into ETFs. And they're building out this sort of core portfolio of these highly diversified ETFs, which is actually pretty smart. And if they've done that, they've made a fair bit of money with the rise of global markets over a really pretty long time. Really since the GFC, the market has just been marching up. And if you've been an index investor, you've sort of been on the right side of the market. It's all been about US tech though. It's the Magnificent Seven. It's the Nasdaq 100 ETF. It's the S&P 500 ETFs, both in Australia and in the US. It's actually surprising how many people are going into the US market to get exposure to the US index. You can get the same exposure here in Australia, but they're doing it.
Why would they do that? Free brokerage.
Yeah. No. Look,
Zero.
I think they sort of want the real thing, right? You can go and buy an iPhone from JB Hi-Fi, or you can go and have the experience buying it from the Apple Store.
That's a classic example because they're both just iPhones.
I know, maybe it's the experience. I don't know. But there's a surprising amount of volume going through on US ETFs as well as Aussie-based US ETFs.
Maybe the superhero customers are particularly sophisticated and they're taking a bet on the US dollar.
Yeah,
But you still have that if you buy the
You do,
Aussie listed.
True, and it's unhedged.
Yeah.
Yeah.
And you can buy the hedge ones now as well, which probably haven't done quite as well. No.
So one interesting thing though, the US and a particular tilt to tech, that is a little different to the average Aussie investor because the biggest ETF in Australia is VAS, the Vanguard Australian shares. So, but that's heartening for me to hear that the next generation of investors don't have the same level of home country bias as perhaps our parents did.
Yeah, look, VAS was number one on the list last year. No, but that was last year.
Oh, yeah.
They're third on the list this year in terms of the most bought ETFs. But if you look at the way the market's been going, it's those 7 big US tech stocks that are just driving everything. And if you haven't been long exposure to them, you've been wrong. Because you look outside of those, the market hasn't really done that much in the US. So it has actually been the right trade getting exposure to them. But yeah, it's Nasdaq 100, it's the S&P 500 as number 2, and then VAS. But it's just all growth. Yeah. People just want growth.
Yeah. So what about stocks? Where are people putting their money when it comes to the individuals? Are we punting? Is it the big caps here in Australia?
Yeah.
What's the vibe?
Yeah, look, I think again, people want growth.
Yeah.
Everyone wants to get on the the next sort of rocket ship. I think the standouts have been in the US market. Nvidia has been, it's overtaken Tesla as the most traded, the most bought.
Wow,
which is pretty interesting. I mean, you look at the chart of that thing and it's just like, it goes up all the time. It's always at a record high. So that's been a standout. But looking here as well, there's some companies that have come back into sort of the most invested. We saw during COVID, we saw the buy now, pay later stocks really, storm ahead. Zip's back up there. And they've been doing well. There was a lot of concern. I know you guys recently spoke about them on the podcast as well, but there's a lot of concern about whether they would make it through in a high interest rate environment. And I think they've proven they've done that. They're highly profitable now. And people are they're still happy to
what is it, up almost 200% last 12 months?
180% in the past 12 months, back in the ASX 200.
I didn't know that. That's good. That's great. Drone Shield's been another one. That's a really interesting company. I actually spoke to the CEO of that business a couple of weeks ago, and it's super interesting. It's been like a day trader's dream. I think they raised $100 million at 80 cents. They went out to try and raise 50, and they just got so much demand they ended up taking 100. It got up to $2.70 and it's come back a fair way now. You look at global events, Trump assassination, like for someone to fly a drone into an event like that would be pretty easy. And these guys have got the tech that sort of, dominates every kind of sort of event like that, where they can actually, shield an entire stadium, or it's actually really interesting tech. It's not just this stock that will keep going up because on vapor. There's actually a really strong underlying business there. So it's interesting to see that. It's obviously pretty volatile. But then looking outside of that, it's all been mining companies.
Really?
So, Pilbara, Fortescue, BHP, a lot of interest in those stocks, and those guys have pushed the banks out of the most traded as well.
Wow. Would not pick that.
So even with a cohort that I assume skews a bit younger, banks and miners still do sort of rank towards the top.
They do. Yeah. The banks are still up there. They'd be in the top 20 for sure. But looking at the most active, like the 5 most active. They're not up there now.
Nice. Yeah. So I guess the final question we want to get is around what Aussies are buying. What does the average portfolio look like? Are you noticing any trends or any structures that are most common?
It does shift based on age.
Okay.
So if we look at, if we look at average portfolio size, you're probably looking at about 10 grand Aussie. In the US, you're looking at about 7.5 grand US. And people are sort of, going 50-50 into both markets. But it's very much, if you sort of look at the Gen Zs up to the millennials, which is now up to 40 years old-ish?
Something like that, yeah.
It's a core portfolio of ETFs, and then you've got a few growth stocks around the edges as the satellite investments. If you looked at the older generations, the Gen Xers and the Boomers, it's all stocks. Like the Boomers don't even go towards ETFs, and they've probably, they've been around a lot longer.
Yeah.
They've got this. It's like, hold my beer, I'm going direct into stocks. So they don't really look at ETFs at all. The sort of the older generation, it's all direct equities. But yeah, look, I think the core cohort of our customer base, it's a core portfolio of ETFs.
And does that change between superhero customers investing in super and then non-super?
Yeah, I think there's two parts of it. There's self-managed super funds that are on our platform. They are typically older customers. We don't have a huge cohort of younger customers with self-managed super funds, and they are typically more sophisticated investors. They are going into direct shares and ETFs as well. On the superhero super side, where you can invest in direct shares and ETFs, we see a pretty balanced mix as well. So we do see people coming in and really trying to get exposure to things that are meaningful to them, that are have a much longer time horizon on their investments as well. With superhero super, you do have a core diversified pooled investment option, which is growth, high growth, those sorts of things, and then you can invest in direct shares, and we do see quite good uptake of that. There are limits on how much you can invest into each stock as well, but yeah, people do typically take a much longer time view on those portfolios.
That makes sense.
I keep running into that trading limit on my super, because I've got it with Superhero on the leveraged ETFs, GGUS and Gear.
Yeah.
So if you could remove those limits from my account, that would be nice.
They're there for a reason. When we started, and I'm happy to talk about this later, but when we started, buy now, pay later was really sort of going gangbusters, and they've had this whole question around responsible lending, and we wanted to introduce that whole responsible investing piece into super. So that's why the limits are there.
Yeah. Look,
to be more responsible.
It makes sense.
My superhero super portfolio, I'm much more conservative with it. So I've got a whole range of sort of top 20 stocks in my portfolio. And I'm like super high risk outside of super. I'm making so much more money in super than I'm making outside. But it's because of that. You are taking a longer term approach to it. And
I'm almost the opposite.
Same. I'm super conservative outside of super, like dollar cost averaging into core portfolio
I take
of ETFs.
way more risk.
Yeah.
But in super, I'm like, I've got such a long time horizon.
Yeah.
If I can have an active tilt or if I can have a leverage tilt, it makes sense there.
Yeah.
But different strokes, different folks.
Yeah, I could talk through what I've got in my super fund. I do have BHP, Fortescue. I've got some Zip. I've got some Block. I think I'm down on my Block shares.
Oh, so you're taking a bit of risk.
I'm taking a bit of risk, but it's more skewed to. Yeah.
Rules it for himself.
Yeah. I think it is skewed to like the top 20 stocks. But yeah, I mean those guys have got. They've performed really well, and it's not to say that they're going to continue. Past performance is not the reliable indicator for future performance, but they've performed well over time. Fortescue, I think they got down to a low of $14 or $15, and they're well up into the 20s now. So it's those limits that force you to be a little bit more conservative, though. And there's rules around why as well.
Fair.
So I guess to wrap up the investment trends and insights, are there any other trends that you're noticing amongst your customer base? Anything they're really favouring or not favouring, or just anything of interest? Yeah,
look, I think the biggest question we always get is particularly from newer investors, is how do I start? What do I invest in? And I think the key trend there, particularly in the younger cohorts, is we are seeing people go into ETFs. And then it's a question about diversification. How many shares should I have? And the data shows that the average customer has got about 5 holdings in their portfolio. Okay. So, if they've got 2 or 3 ETFs, that's giving them broad diversification across
the world,
potentially multiple markets, and then they've got 1 or 2 individual stocks in their portfolio as well, usually of a smaller dollar amount.
I mean, it all sounds like people are investing pretty well on the whole. Like, I compare how I started investing, going all in on one company that I lost all my money on, and you compare it to people now starting with ETFs, and then like a big thing that we've noticed people were doing was they would have 10 ETFs and like heaps of holdings, like way too many lines on their brokerage, and now it seems like people are rationalising it. So it feels like the Aussie investors doing okay.
Yeah, and look, the market has been very favourable to investors. It's when markets go bad that that diversification is key. There's a guy that came up to me on my first day I was at Shaw Stockbroking, which is now called Shaw and Partners, just before the GFC. He came up to me, he said, "What are you doing here?" I was like, it's my first day. He goes, "Leave while you still can."
No way.
Thanks. And then the GFC hit, and he came up to me and he said, "Just remember this time, because the next generation will forget." And the next generation has now come into the market, and they haven't seen that. Like, they may have studied the GFC at uni, but they haven't actually experienced that. It's just been a bull market for the last 10 years or so, probably longer. So diversification is key. To anyone listening, make sure you stay diversified, because it will save you when things do turn the other way.
Minus the COVID blip, but that turned around pretty quickly.
Yeah, that was like a week. Went down and then straight back up.
And the interest rate panic of 2022 and 2023. I mean, it wasn't the GFC, obviously, but we've had some times. yeah. But it's bounced back pretty quick.
Very easily.
It's nice.
It's nice. So, John, let's turn to your journey in business, because you've started a fintech, and I guess there's a lot of people in our audience who are thinking about starting businesses themselves. So, talk us through the journey to date. Why did you start it, and what have been the drivers?
Yeah. So, as I said, I started at Shaw Stockbroking before they changed their name way back in the mid-2000s. I left there. I joined Macquarie, another smaller broking firm, when I was living in Perth, and then rejoined Shaw. Worked really closely with the Zip guys when they IPO'd, and it was during that time where there was just a fundamental issue with the way I was sort of doing business as a broker. It just didn't resonate with people my age. It was paper forms, it was certified ID that needed to get posted to the office, and there had to be a better way to do this. So the fundamentals of what we were doing weren't going to change, but it was about access. It was the accessibility piece. And Zip was doing real-time credit decisioning at the checkout while you're buying a pair of jeans with 3 people in the line behind you. And we were taking a week to get an account set up. And then it was $100 and something of brokerage. It just didn't sort of fit. And it does fit a certain investor. It fits, for an advised group, high net worths. It suits that, but it doesn't suit retail investors at a mass scale, who ultimately want to explore research and sort of go about it themselves. And that was sort of the trigger point. But the real light bulb moment for me was when I'd sort of gone out and spoken to a whole bunch of people, and they're like, "Yeah, I actually don't have that much money to invest, but I've got all my super. How can I sort of? Is there a way that I could use my super to invest?" And that was sort of the real light bulb moment behind Superhero. You fast forward to today, we've got a super fund that you can choose how you want to invest parts of your super, as well as a share trading platform that sort of gives you a broad range of access at very low brokerage rates.
So how did you go about taking that idea and then I guess going out and raising a fair chunk of capital to build the tech.
Yeah.
You came from a broking background, so no tech experience.
Yeah.
Maybe, I don't know if you could code or not, but how did you go about that? And then advice for those that have the similar ambitions in wanting to raise capital and start something from scratch.
I thought I knew enough about tech. I knew I needed help though. And I went and spoke to a good friend of mine who was a developer. He was working for another business. He sort of had a look at this and was like, that's really interesting. I want to get involved. I said, great. We've got this whole plan. We're going to be live in 3 months and away we go. And it took 3.5 years. I blame him for that. He'll be listening to this and laughing. Yeah, I think you need to realise where your strengths are. Tech was not my strength. I understand it now. I can't code, but I understand what is required. And it is more difficult than you think. The sort of the key piece to starting a business is understanding where your strengths lie and making sure you bring in the knowledge you need to be able to deliver what you want. And that changes over time. So you're constantly bringing more skill into the business. Yeah, so that's probably the biggest sort of learning I had over the journey. No one knows everything, and it's how you bring that skill together that ultimately makes you successful.
You would have had to first raise money on really an idea and a plan, I guess, while the tech was being built. That is a challenge for a lot of people who want to start a business, especially when they don't have something, fully formed, going out and trying to raise money. So how did you do it, and what advice do you have?
It's really hard. There's definitely skill that's involved, but there's absolutely luck as well. And if you look at the timeline of when we raised capital, I think our first capital raise was in 2018. We'd listed Zip. There was, that thing was going up every day. A lot of my clients were in that, and that was sort of the initial group of people who I tapped into. We were already having investing discussions every day. So it was an easy conversation to say, this is what I'm doing. How can we get you involved? The biggest chunk of cash that we raised was a $25 million raise in 2021. That was wild.
Yeah.
Wild.
Yeah.
We went into meetings trying to raise like $5 million, and we walked out with 25.
That's a good meeting.
Oh, it was. Yeah. I mean, zero interest rates. Money was basically free.
And it was that growth mindset as well. Just burn it.
Yeah. It was.
That's what everyone was doing at the time. Here's money. Go out and burn it.
Inefficient growth.
We'll give you more.
Yeah. And we got a call from some of those investors 6 months later, and they wanted an investor update, and we walked out with another 15.
Jeez.
No way.
Yeah, it was wild. You fast forward to today, and it is really difficult.
Yeah.
It's really hard, even for an established business, to raise capital.
So just for those listening, perhaps explain why. What's the dynamic that's changed?
I think there's capital available to, certainly the listed space is a lot easier. People want liquidity. They're happy to pay a premium for profitable businesses. But the days of spending money to acquire customers on an unprofitable basis are dead. There's small amounts of capital for startups, but you have to have a really robust business plan that shows how you get to profitability quickly. That's a challenge for when you're starting a business. You do need a runway to be able to prove out the business model, prove product market fit, and grow. So yeah, it's challenging. I've spoken to a whole bunch of investors and businesses that are trying to raise at the moment. The investors all say, yeah, we've got plenty of money to invest, but they're not, allocating capital is not widely seen for unlisted, for private businesses.
Yeah. You got to be B2B SaaS to get money these days.
Or AI.
Or AI.
Yeah, no, for sure.
So Let's turn back to Superhero, because as I said earlier, we got a bunch of questions from the Equity Mates community. You got questions from the Superhero community, and so we wanted to throw some of those in. Let's separate brokerage and super, so the two parts of your business. Starting with brokerage, we got a few questions about the $2 price change, which does mean you're the lowest brokerage in Australia for a brokerage platform, but there were some people who had who got used to $0 ETF brokerage when they were buying. So I guess talk to us about the decision, how you made it, and then how you're thinking about it today.
Yeah, pricing changes are always hard when you're lifting prices. They're always easy when you're dropping them. From a customer point of view, there is an underlying business behind it as well that we had to consider. I think the pricing change was driven partly from a competitive standpoint. We've seen a couple of people come into the market at $3 brokerage. We do have a model that was unique, that's pretty widely available in the market now, that leverages a custody solution, which allows us to have a lot more flexibility on the price that we charge. And we really want to deliver that value, that efficiency that we drive, we want to deliver back in value to our customers. So we had the ability to go to $2 and still keep the economics in check. However, that did mean that we had to go from 0 on ETFs to $2. But in saying that, we've gone from 5 on when you sold to 2 as well. So, there was different levers that were sort of pushing and pulling. Overall, we think that we've delivered a pretty amazing price to the market, and repositioned ourselves at $2, where we know a lot of our competitors just can't play.
Yeah. Well, speaking of competitors, another question that's come through is around competitive advantage. Outside of price, what other competitive advantages do you think you have?
Yeah, looking on the trading side, I think we're always evolving the product, but we want to be seen, we don't want to be seen just as the cheapest broker. We want to be seen as the best value, and how we deliver that value is constantly changing. But some of the key things that we've got is live pricing. So we have live ASX and CBO pricing on the platform for the Aussie markets, which we don't see across all of our peers. And then we've got NASDAQ pricing, live pricing for US. So that's a big one. We don't actually sort of market it too heavily. We do see some of our peers sort of really pushing the live pricing piece. It's just part of our product. Yeah. It's part of that value add. One of the other big things, and I really saw this as a massive value driver when I was a broker, was around having consolidated reporting across your portfolio. So you get to the end of the financial year, you've got to report everything to your accountant, or you're doing it yourselves. And it's like you got to go and find out, but what I bought those there and I sold them there and I got it paid a dividend and I've got the dividend statement at home somewhere. We've consolidated all of that. Because of our model, we've got we can track every single transaction on your account, and then we report that back to you. So we used to charge 1% of your portfolio value just to provide those reports.
When you say we used to, you mean in a previous life,
not
in a previous iteration of Superhero.
And like you had a $3 million portfolio. That's $30,000 a year for a report.
Yeah.
Wow.
Like you can just download it on Superhero.
Yeah.
So, and there's other providers that you can upload all your transaction history to, and they'll give that to you as well on a subscription basis. We've built that in. That's part of the value. Apart from that, we are looking at how we continue to deliver more value. Through stock analysis and a whole range of different content pieces that are sort of embedded in the product.
Nice.
Well, let's turn to what you're thinking about and adding more value, because there were a bunch of questions that came through about the product pipeline generally, and then there was one specific one that came through a few times around automatic dividend reinvestment. So can you talk about the product pipeline and perhaps if that fits in there?
DRPs. Yeah, it needs to feel natural. From when you log into the app, it's like, what information do you want to see straight away? And that changes depending on who you are or what you want to see at the time. So, that's a constant research piece. And we do survey our customers. We do have one-on-one interviews with a whole range of different customers as well to understand exactly what what they want and then be able to build to that. But there's a whole range of things around charting, around price targets, content that is actually meaningful at the time that you're making a financial decision. DRPs is a big one. We do get asked that all the time. It's surprisingly difficult. And that's probably why you don't see it across all of our competitors as well. Embedding a DRP process into your product is hard. To enable it, it's typically through the registry, which is pretty clunky process. We are working on it though. There's always this healthy tension between, prioritising different products. It is being worked on.
Nice. Watch this space.
Yeah, there's a whole range of things on corporate actions as well. That's one of the things that we see as a big value add as well with Superhero is you don't get a entitlement offer sent to you in the mail that you've got to fill out a form and send it back, or you kind of log into this system over here. It's all done. There's an email notification. There's a form that you complete online. It pulls the cash out of your account and delivers you the stock. It's all pretty seamless, and we're constantly improving on some of that. There's some new areas of the app that'll pop up pretty soon on corporate actions too.
Nice. So that's the trading side, but what about Super? What does the product pipeline look like? Currently, you can invest in ASX 300. When am I going to get access to the speckies?
Yeah. I actually emailed John recently about a few active managers that I wanted to see in there.
Active ETFs.
Yeah, look, Super it's a long-term investment. There's a range of different checks and balances that come into play on the investment menu. When we look at the investment universe, there's demand requirements that we need. It may just be you who wants those active ETFs. But I think, if you look at, the diversification across portfolios, you can go into our managed investments, which are, they're run by a partner of ours called Mercer. They run hundreds of billions of investments. They run a conservative, moderate growth, high growth portfolio for us. The portfolios are highly diversified. And then you can add in ETFs and ASX 300 shares into that. And there's limits on those, as we mentioned earlier. But you can diversify your portfolio in a pretty interesting way that sort of suits where you see value. But going too far down the list starts to create issues. And we've seen some of those where something may drop out of the index or something may go into administration or get delisted. And then you've got a super fund that is holding delisted assets, which just creates complexity. So we're trying to stick to quality. We're trying to provide diversification across the investing landscape, but we need to do it within certain guardrails. But I'd love to have some Apple shares in there and things, but it is challenging. It's challenging from a reporting point of view as well. It's a retail super fund. It's not a self-managed super fund where you can choose
full control.
Well, John, one final question, just around the Superhero strategy more generally, I guess. People saw the potential SwiftX tie-up that didn't happen. So I guess how are you thinking about the business long term? You're going to get bought? You're going to start buying other people? You're going to list? What's the long-term vision that you have?
Yeah, it's been an interesting journey. We've raised probably $65 million over the journey, which is a big number. We sold the business to SwiftX, great company, great guys. The market was pretty challenging when that transaction occurred. The crypto market was dropping. I think interest rates were going up, trying to think back.
Big time.
And there was external pressure around putting crypto and financial products together in a single environment. And that's really why you haven't seen it very much in Australia. So that it really didn't sort of come together as both parties hoped. And we amicably sort of unwound that transaction and sort of went our separate ways. I do see them all the time. Their logo probably stands out more to me than most. But look, in terms of our strategy going forward, I think we're focused on continuing to grow, on a profitable basis. Where we go from here, listing is interesting. I think there's some real opportunities that we see in front of us that are longer term opportunities, and the challenge that I see with listed companies is that it really takes you to a quarterly focus. And you know, if you're trying to get something done in April and it slips to May and then it actually goes into July, then your share price gets marked down, but it's actually only like 3 days, 3 days after the quarter, but it doesn't count. So there's some of those challenges that we're constantly weighing up. But yeah, I think, you know, there's a huge amount of interest from our customer base around investing in Superhero. So I think when the time is right, that's an interesting conversation to have to our audience. But yeah, we're heads down. We're growing the business. We're growing the super fund. It's pretty interesting times. But when you're running a business, it's a constant roller coaster.
Absolutely, we can relate to that.
Yeah. Well, John, probably not on the $65 million level.
Not on the $65 million raise. One day. But John, thank you so much. We've certainly enjoyed watching the journey. As Alex said at the start, like anyone that is out there trying to make investing accessible and affordable for the retail cohort, we're all for it, and you know, we both love using the platform as well. So appreciate everything you've done and coming on today, and thank you to everyone who submitted questions as well. Thank you very much.
Thanks for having me. It's a good chat. Thanks, guys.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.